Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Analysis Document, May 20, 2026. This video presents a direct informational narration of the source document. So let's dive right in. Looking at our agenda today, we've got a really packed lineup. We're starting off with macro and geopolitics, then moving right into tech and semiconductors. After that, we'll hit retail and travel, take a look at power and utilities, and finally wrap things up with software and corporate actions.
All right, Section 1, Macro and Geopolitics, focusing on oil inventories and trade routes. Let's get into it.
So, the international crude oil futures market saw some absolutely massive volatility. During early trading, data dropped from the U.S. Energy Information Administration showing a record-breaking plunge in U.S. crude inventories. We're talking a drop of 17.8 million barrels, which is way past what the market was expecting. Add to that, U.S. crude exports hitting historic highs, and you can imagine the reaction. This initially sparked major fears that global oil supply was tightening up fast, which actually narrowed some early losses. But then, almost immediately after, a statement from Donald Trump came out saying that U.S.-Iran negotiations had entered their final stage. Right at the same time, media reports started rolling in that some tankers were already resuming transit through the Strait of Hormuz. Because of this, the whole war premium just vanished into thin air. WTI crude futures tanked, falling below $100 a barrel, making it the largest single-day percentage drop we've seen in nearly 2 weeks. Now, according to Al Arabiya, the text for the U.S.-Iran agreement has literally entered the final polishing stage, with negotiations set to continue. The next round of talks is locked in for right after May 31 in Islamabad, Pakistan. On top of that, the Iranian Islamic Revolutionary Guard Corps Navy reported that within just a 4-hour window, 26 ships, including tankers, made their way through the Strait of Hormuz under coordination. British maritime media backed this up, citing final data that between May 11 and May 17, at least 54 ships transited the strait. Compare that to just 25 the week before. So what does this all mean? Basically, these updates totally shifted the core market logic away from fears of a long-term closure of the strait and firmly toward the easing of conflicts and getting transit back to normal. You know, it's pretty clear the oil market right now is this highly politicized, super emotion-driven geopolitical risk market. Sentiment can flip on a dime based purely on news about the Strait of Hormuz or these ongoing negotiations. And as oil prices fell, those short-term inflation pressures started to cool off, which in turn dragged down U.S. Treasury yields. We saw the 10-year yield take a really significant dive, falling from 4.7% down to below 4.6%. This synchronized movement was honestly the key catalyst for a nice rebound in U.S. equities from their recent lows. The Nasdaq showed collective strength across the board, with literally every single sector advancing, except for oil and discount retail. Moving on to Section 2, Tech and Semiconductors, where we'll look at Nvidia's earnings and overall index trends. Okay, let's talk about Nvidia. They just released their fiscal year 2027 first quarter earnings report, and the numbers are staggering. Revenue hit an unbelievable $81.6 billion. That's an 85% increase year over year. The data center business alone pulled in $75.2 billion of that total, which is up 92% from last year, with hyperscale cloud services bringing in about half of it. Net income came in at $58.3 billion, and adjusted earnings per share were $1.87, a massive 140% jump year over year. Looking ahead, the company is projecting Q2 revenue of $91.0 billion, and they confirmed VRN deliveries are kicking off in the third quarter. Plus, as a little cherry on top, the board authorized an additional $80 billion for share repurchases and raised their dividend to $0.25 per share. But here's the crazy part. Despite those incredibly strong fundamentals, Nvidia's stock actually showed some real hesitation after hours, trading slightly down. Over in the options markets, traders are pricing in an implied stock move of about 6.5% for the upcoming session, which just goes to show there's a ton of uncertainty in the air right now. Looking at the technicals, the QQQ ETF's upward trendline was officially broken and has now flipped from support to resistance, with the recent little bounce just barely touching the lower bound of that trendline. Meanwhile, trading volume has stayed pretty flat. The takeaway here, without a major positive catalyst from Nvidia to hold up the broader market, QQQ is highly likely to run into serious resistance at this trendline and could very well go test lower support levels. On a brighter note, the Philadelphia Semiconductor Index surged 4.5%. A huge factor behind this was the Samsung Electronics Union deciding to hit pause on their large-scale strike. Instead, they've scheduled a vote on a preliminary wage proposal between May 3 and May 28. South Korea's labor minister even chimed in, saying the union and Samsung actually reached a consensus on profit sharing. This was a huge sigh of relief for the market because it totally eased fears of a memory supply disruption. Because of this, CPU makers like AMD and Intel saw a massive surge. AMD shot up over 15%, totally smashing past its recent high of $240. Wall Street is clearly staying super optimistic about the CPU market right now, especially as artificial intelligence shifts from large model inference over to the intelligent agent stage. All right, let's shift gears to Section 3, Retail and Travel. We've got sector rebounds and target earnings to cover. Now, speaking of that shift to agentic AI applications, this demand is projected to absolutely skyrocket the server CPU market. We're looking at a jump from $29.3 billion in 2025 all the way to $131.5 billion by 2030. That's a compound annual growth rate of 35%. Because of this explosive projection, target prices for Intel and AMD just got bumped up to $130 and $460 respectively. Meanwhile, in completely different sectors, that plunge in oil prices we talked about earlier, it fueled a massive rebound in cruise and airline stocks. Delta Airlines surged 10%, literally erasing 10 days of losses in one fell swoop. Norwegian Cruise Line jumped over 8% as well. Remember, they had previously pulled back about 35% since mid-April because of high fuel costs and the whole hantavirus situation impacting their bookings. It's worth keeping in mind, though, that the source notes Norwegian still has the weakest fundamentals among the major cruise lines. Moving into retail, Target came out with some really strong Q1 2026 earnings, beating both revenue and profit expectations. They even raised their full-year revenue growth forecast. After 3 tough years of post-pandemic revenue declines, it looks like their turnaround efforts are finally paying off. Several institutions actually upgraded Target's price target, but strangely enough, the stock still fell after the earnings dropped. Why? Well, Bank of America kept an underperform rating on them, pointing out that fading tax refund benefits, high gas prices, and sticky inflation could really drag down discretionary spending in the second half of the year. On the flip side, expectations for Walmart's upcoming earnings are looking super positive. Walmart has beaten revenue expectations for an incredible 19 consecutive quarters, and they've topped EPS estimates in 8 of the past 10 quarters. They're in a prime position to benefit from top-line expansion driven by inflation and consumers trading down for better deals. Let's jump into Section 4, Power and Utilities, where we have a truly historic acquisition to discuss. So the nuclear and power sectors surged across the board, mostly because those falling U.S. Treasury yields we saw earlier really took the pressure off. But the sector got red hot following Constellation Energy's massive $67 billion acquisition of Dominion Energy. To put that in perspective, that is the largest utility buyout in U.S. history. Capital is aggressively rotating back into the power sector right now, heavily driven by narratives around supply shortages. Stocks like NNNO are showing incredibly high elasticity, while your more traditional utilities like VST are maintaining super stable fundamentals and really strong, predictable cash flows. In fact, VST gapped up and closed right above its 5-day moving average. The source even specifically pointed out that levels below $134 for VST are looking like a very attractive entry zone compared to its fair value. Finally, we arrive at Section 5, Software and Corporate Actions, balancing growth against some emerging risks. Over in the AI data center space, interconnect company Astra Labs went on an absolute tear, surging over 17%. That brings their year-to-date gain to a whopping 73%. The Royal Bank of Canada is keeping an outperform rating on them with a target price of $250, mainly because they expect Astra to really benefit from AWS deployments. But it's not all sunshine. There are definitely risks to watch. Think slowing AI capital expenditures, potential dilution from Amazon-related warrant transactions, and a pretty steep forward PE ratio sitting at 72x. Now, pivoting to the consumer space. Hasbro reported Q1 revenue jumping 13% to cross the $1 billion mark. Their net income almost doubled, hitting around $200 million. You'd think that would be a slam dunk, right? Well, despite beating those estimates, their core consumer products actually stagnated, and entertainment revenue completely tanked by 24%. Because they didn't raise their full-year guidance, the stock actually took a hit and declined post-earnings. Wrapping things up, Intuit reported their Q3 fiscal 2026 results. Revenue came in at $8.561 billion, which is a solid 10% increase year over year. Adjusted earnings per share landed at $12.80, which nicely beat the expected $12.60. The company was confident enough to raise its full-year guidance and even approved a massive new $8 billion stock repurchase plan. But here's the kicker. Despite all that good news, the stock dropped significantly after hours. The source suggests this decline is likely tied to some newly announced layoffs. More importantly, it notes that this could be a major red flag signaling broader weakness across the entire software sector, which might force the market to rely even more heavily on AI hardware just to keep things stable. So the big question is, if software continues to stumble, can AI hardware really carry the entire market on its shoulders? We'll have to wait and see.